My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to save you some money. My job is not just to entertain, but also to educate and teach you about days like today. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. How do you get your head around a day like today? Dow plunged another 800 points. S&P is down 2.93%. NASDAQ even worse, off 3.02%. Well, it's all about the bizarre action, or at least a symptom, perhaps, of the bond market. And you got to remember that the bond market is a lot larger than the stock market. Even though unemployment is at its lowest level in 50 years, something disconcerting has happened with bonds. Earlier today, the benchmark 10-year Treasury had a lower yield than the 2-year. That's a highly unusual setup. We haven't seen it since, yes, the eve of the Great Recession of 2007. And we have memories. The yield in the 30-year Treasury has fallen to record lows. Again, that is piercing. And as bond yields fall off a cliff, they're taking the stock market with them. Why? It's all because of precedent. See, the bears will tell you that anytime we see treasuries behaving like this, a recession surely follows. Long-term interest rates don't drop below short-term rates unless people are really worried about the future. So even if things seem fine in the economy now, there's a widespread fear that they won't stay that way and that things could get worse in the future. Now, I think that could be a misread of the current situation, but I can no longer dismiss these concerns given the pronounced moves in bonds that we saw Monday and today. As I've told you repeatedly, I do not believe we're headed into a recession anytime soon. But a lot of people clearly disagree with me, smart people, and history is on their side, not mine. So tonight I'm going to put on my doom and gloom investigation hat and offer some theories about what's driving this action because, what can I say, it's too extreme to dismiss. I'm not going to whistle past it. Keep in mind, I'm going to give you some pure conjecture. I don't know any more than anyone else who obsessively keeps track of publicly available information. But I do have my ear to the ground, so to speak, so I can tell you what I'm hearing. All day today, people were talking my ear off about an elephant in the room. And then they'd each mention a different elephant. Either we have an overabundance of pachyderms, or some of these doomsayers are blowing things out of proportion, or both. Let's go through the negatives. First, there's a sense that our trade war with China is starting to tank global commerce. All the amateur history buffs in the stock market are convinced that we're going to revisit the Smoot-Hawley tariff, when we put up massive barriers to trade right as the Great Depression got rolling. Memories. These bears think the trade war will be devastating, and the bear cohort has grown dramatically. If that happens, you want to put your money in a safe haven like treasuries. And man, oh man, are they ever doing that? They're buying treasuries hand over fist. Of course, if this theory is true, and we reach some kind of deal with China, everything that's been getting hammered will come roaring back. But that right now doesn't seem to be in the cards. Second, our short-term interest rates, the ones set by the Fed, are way too high. Last year, Fed Chief Jay Powell raised rates repeatedly without putting much thought into the impact that they might have. We know that from his thoughtless comments in October. They were very bad. This is why President Trump just tweeted that the Fed is clueless. Now, I think he was trying to help the stock market, but it backfired because harassing the Fed chief just isn't at all that constructive, even if Trump was right and is right. Look, love him or hate him, I think he is actually right about monetary policy. See, the Fed could instantly cut rates, solving the inverted yield curve problem and giving the economy a nice boost. Oh, and while long-term rates are this low, it's the perfect time for the government to borrow a huge slug of money to fund some infrastructure spending. But that would require the White House and Congress to actually work together, which is pretty unlikely. Maybe you could slip it in, I don't know, in some sort of infrastructure bond. But suffice it to say that I think Trump is right, and the Fed has not done a great job. They took rates much too high. Third driver of the bizarre bond market, a huge percentage of government bonds in the rest of the world now have negative interest rates. When that happens, it's typically because these countries have very little economic growth. As I keep telling you, this situation causes massive amounts of foreign money to flow into U.S. treasuries, where you're getting a much better return than you get from, say, German bonds. They have to buy dollars first. That's what's propping up the dollar, making us less competitive. Point four, our bond market is signaling that a recession is right around the corner. And there's some parts of the economy that do reinforce that view. You could argue that aerospace, long one of the strongest sectors in America, is grinding to a halt because of the problems with Boeing's 737 MAX. Boeing's actually big enough that they can move the needle in terms of the GDP. This very evening, Cisco, the giant technology company, talked about seeing some cracks in the global economy. That's surprising. It will hurt all of tech tomorrow because Chuck Robbins, the CEO, is a cool and calm-headed man, but he did give low guidance. Meanwhile, Macy's just reported a horrific quarter this morning. It's a warning sign that some parts of the consumer landscape could be in trouble. Now, of course, Macy's might not represent the way people shop anymore. These are full-price mall-based stores, for heaven's sake. But the quarter was definitely worrisome. I'm going to have to talk about more about it later. Still, Boeing, Cisco, and Macy's all headed in the wrong direction. For me, since this is all new, I find this worrisome. Fifth, the Brexit deadline is rapidly approaching, and a hard Brexit, okay, let's call it what it is. Now your eyes glaze over, but it could be a disaster. Go to Europe. This is what people talk about when I'm over there. Maybe it causes a freeze in European commerce, just as there's a dramatic decline in Chinese consumption, where they sell a lot of product. A specter is haunting Europe, the specter of a Brexit-induced depression. This is the Armageddon scenario that could potentially lead to the failure of major European banks and a total shutdown of credit. It wouldn't shock me that European banks are trading as if they are in big trouble. Six, the trading floors were all alive with talk today that this decline reflects a belief that Bernie Sanders or Elizabeth Warren might win the election. Both senators make no secret of the fact that they want to crack down on capital. So we better get used to the fear that they instill among wealthy people who own lots of stocks. That could explain why the dividend stocks keep getting hit, right? Because even though the bond market competition is upside down, well, think about it. Makes sense. If investors expect the tax cycle on capital gains and dividend income, they'd be dumping them. That could happen. It's not going to happen unless the Democrats nominate one of the more left-wing candidates and then sweep the Senate next year. But maybe some managers are trying to price in that possibility. If so, we've got plenty more to fall. The seventh and final explanation, several large institutions might be shorting bonds, betting against them, and as bond prices keep rising, they're getting squeezed and could be about to go bust. Now, it may sound far-fetched, but we saw something similar in 1998 with the failure of long-term capital management, a hedge fund run by allegedly smart people who took some incredibly stupid risks that ended up doing tremendous damage to the market. Go read Confessions of a Street Addict if you want to know. So which is it? Well, for the moment, it doesn't matter, does it? Whatever the cause, we can't not ignore the bond market's behavior. It's too extreme. Of course, many of these negatives are reversible. Almost all of them are man-made and can be reversed. They can be unmade. Right now, though, our stock market is handcuffed to the bond market. As long as that's the case, the momentum is with the bears, not the bulls. Even if the bears ultimately turn out to be wrong. Ultimately, it's a long time from now. In stocks and bonds, momentum matters. And while it can be irrational, it is wrong to ignore it. This market is now largely ruled by fear. I don't like being scared into anything when it comes to my money or yours. And remember, panic is not a strategy. Eventually, I believe the Cassandras will be proven wrong. I still think the economy has some strength to it, or at least strength enough to avoid a recession. But in the interim, I accept that being calm and patient has gone out of style. I want to be opportunistic and say the bond market's just plain wrong and there's plenty left to buy. The truth is, though, we've been selling for my charitable trust, which you can follow along at actionalertsplus.com. We just raised cash. The bottom line, I don't blame anyone for raising some cash here. My trust did. But it would be a big mistake to sell everything. You don't panic when the economy's hanging on. You wait for more of a decline. Remember, the S&P is still up 13%. The NASDAQ is up 17%. And once it comes down, then you can do some opportunistic buying. Let's go to Larry in New Jersey. Larry.
Hey, Jim. How are you? Thanks for taking my call.
Oh, thank you for calling, Larry. What's up?
I'm holding Prudential right now, ticker PRU.
Right, that got hammered today.
Yeah, they did. Historically, they've been a pretty strong stock with a good yield, and they've got a compelling value proposition to make financial wellness widely available. They've got a unique business mix to execute on that as well. But still, they've been trading at or below book value for a while. Management's been pretty opaque about the investments they're making to become more efficient, and recently the stock dipped almost 20%. They had a bad earnings recently, partly due to updated assumptions in their individual life business, which they struggled to improve the return on in recent years. So I'm wondering if this recent sell-off presents a buying opportunity or if you would recommend holding and seeing where things land.
I don't like the way this stock acts. I just don't like it. I'd like to have them on. I mean, there is something very wrong with where the book value is versus where the stock is versus the high yield. And I have to tell you, I think Pru is a fabulous company, but I got to throw the red flag. I don't know enough. We got to learn more because that yield is too high and that book value is too high. Let's go to Bud in Ohio, please. Bud.
Booyah, Ski Daddy.
Yo, Bud, what's up?
Hey, thank you again for talking sense when the markets turn goofy and everybody's peddling fear.
Thank you.
One of the things I've been trying to do is I'm trying to incorporate your lessons about discipline. And one mistake I've made in the past, I'll admit, is buying all at once. So now I've raised some cash, and I'm looking at buying with wide scales on the way down, just like you teach.
Good.
But your recent show on flash crashes got me thinking. Let's say I want to buy some more XYZ stock down 8% from my initial basis. As I watch it trade and I do my homework, why not have a standing good till canceled limit buy order at down 25 or 30%? Just in case there's another half-hour flash crash that I missed because I'm at the supermarket.
Look, down that much might be interesting because there you are not going to get it down 50 after down 25. That's my worry. I think that's okay. I traditionally like people to always focus on their orders themselves and don't do anything like that. But if you're going to put a standing order all the way down, that's intriguing to me. As long as it's not 8 to 10 to 12 to 14, it's down 25. But remember, here's the issue. There have been the flash crashes that have even, for some stocks, down 30 or 40. So I would use an even wider place to do it. I may not get hit, but that way I won't be worried. Let's go to Jacob in New York. Jacob.
Hey, Jim. I got into Dropbox at 1940. Thought that was a deal. Apparently it was not. Should I hold or get out? What are your thoughts?
Mr. Howson's done a great job, but holy cow, there's a lot of competition coming in at them now. And that's the kind of stock that's not working, and it won't work tomorrow when Cisco says that they see a slowdown. Remember, Cisco really put the knife to a lot of the expectations of technology tonight. So there's going to have to be a readjustment. And I think many people will find it surprising. Momentum right now, people, is with the Bears, not with the Bulls. And it's because of this bizarre bond market. And I think with a good economy, the Bears could end up being wrong, but I can't be certain right now after what happened with the bonds. Well, Mad Money tonight, it was a disaster on 34th Street today. I'm focusing on the broader implications of Macy's massive earnings miss. Then, after today's knockdown, drag-out session, I know you've got questions. I'm opening up the phone lines to hear from you, Cramerica. Remember, we can be constructive, but we can't be Pollyannas. After a painful day for the averages, there are some silver linings. We're going to point out a buying opportunity or two, but let's not get overconfident and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.